Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And before I start today's video, I want to thank some of you. You gave me some critiques about my microphone. I just bought this fancy new Yeti microphone, which, by the way, I'd had before, but the other one broke. And I guess I didn't calibrate it correctly, so apparently my volume or my sound quality was pretty bad. So I want to thank y'all. I believe I've got it calibrated now. So anyway, let me know if this quality isn't better than it was before. But I want to thank you for the feedback. And also for those of you who also noticed, I have shut my phone off. But anyway, let's get on with this video because I have a very interesting subject I want to talk about today. What I'm really going to talk about here is I'm going to talk about the market itself. And, the S&P 500 is probably the greatest proxy for the market out there, the most commonly used proxy anyway. And, this is a capitalization weighted index, which means some of the largest cap weight stocks, names like Microsoft and Apple, really tend to dominate the value of this particular index. But what I want you to do, I want you to look at the S&P from a practical way. And the title of this video is going to be, maybe we should harvest some of the high-priced or expensive tech in your portfolio and replace it with some cheaper tech or some better value tech. So let's look at that. This is a cap-weighted index. So we've got Microsoft, Apple, Google, Facebook, Netflix, names like that are really dominating this index. But regardless, I want you to take a really cold-hearted look at the index, and I want you to take a practical look at the index. All right, so I'm going to take price off the graph and the normal PE off, and I want to just look at earnings. As you can see, there's a little bit of cyclicality in the 500 stocks earnings power, if you will, over this last decade. This goes back to 2001. But I also want to point something else out about this. The earnings growth has been about 6%. Now, if I shorten this time frame to where we're just kind of coming out of the Great Recession, that runs it up to about 7%, this has been really kind of extraordinary growth. If I go back even further, I went a little bit too far. If I go back to 13 years, we have almost 9.5% growth. These are very high rates of growth for the S&P 500 at large. All right, I just want you to be aware of that. But the other thing I want to point out is that, for companies or for, any investment growing at that rate, we're using a 15 PE ratio, which represents a 6.67% earnings yield as the valuation reference. Now, the key is that's a theory. So let's take that theory now and test it in the real world. So let's put price on this graph and let's look at how often or how closely the price correlates to that 15 PE. And then let's ask ourselves a question, is that a reasonable valuation? Well, going back for the last 2 decades, you can see some real clear evidence here. You see high valuations where the PE got up into 25, and that, culminated in really poor returns for a decade or so. This was commonly referred to as the lost decade. I didn't measure it perfectly, but you can also see that when you have good valuations on the S&P, you get some really stellar performance out of the S&P. You get periods where, since June of 2010, the S&P's averaged over 14.5%. Now that's collecting dividends but not reinvesting them. Now, if I put the normal PE on the graph at the same time, this is another valuation reference. And what I want you to see practically is now I've got a PE of 15, which is the orange line, and I've got a PE of 18, which is the blue line. So anywhere the price touches this blue line, it's a PE of 18. Anywhere it touches the orange line, it's a PE of 15. And for most of this time frame, the market stays clearly within those two, I'll call them valuation references. This is kind of high value or fully valued. This would be, I would call fair valued when the price is touching a line. Again, every time the price gets significantly above that, it tends to revert back into the valuation corridor, if you will. Now, clearly, looking at this evidence, we see a very, very high valuation on the market. Now, let's test growth rates a little bit. Let's look at the last, let's say, 8 years, which includes a couple of years of forecasting. And now we've got growth rates back down to the 6.78%. So growth hasn't changed materially. Now, we are expecting a very high growth rate for 2021, but that's only because we came off a negative growth rate of 15% during the classic 2020 COVID year, we'll call it, that we all would, of course, willing to forget about. So if I look forward at what the S&P is looking at, analysts are looking at about 5% growth over the next, averaging over the next year or so. And if I look at longer term growth, this is a very optimistic 8.5% growth that analysts reporting to FactSet are looking for. But the main point I want to make here is just to kind of finish this, look at the graph. This is clearly a highly valued market. You can look at the Schiller, PE, you can look at all different kind of measurements, trailing PEs, forward PEs. There's all kinds of valuation references out there talking about the market, and almost universally everybody, calls it a bubble. Well, to me, this graphic really tells that story. This is a very, very high valuation historically on the S&P, and that usually is not a good sign of future returns going forward. But I do want to point out this is primarily a tech bubble, okay? In other words, the vast majority of this high valuation comes from some of these really massively, valued tech stocks. So let's go ahead and look at some of those tech stocks, if you will. The first company I want to cover, of course, is Apple. Apple is a $2.1 trillion market cap company. That's obviously putting a very heavy weighting on the market. Now, I want you to look at Apple historically. I want you to look, their growth rate has been 17.54%. That's very, very high growth when you consider what I showed you with the S&P a moment ago. But now let's move on. Let's look at what growth has been for just only the last 10 years. The last 10 years, it's fallen down to 13%. Let's cut that out to the last 6 years, and the growth is still sitting around 13%. If I look at forecasting growth, we're still looking at 12.87%. That's extremely high growth for a company of this size. And the long-term trend line growth is pretty much the same number, calculated about 13% growth. But here's the point I want to make, that historically, this company has actually grown faster than that. And yet, historically, the market has valued this somewhere between a 14 PE, which is the blue line on this graph, going back to, prior to the Great Recession. And then the upper end is the 17.37, where I'm using the P equals growth rate formula here. So, a 17 multiple, I think, would be very reasonable for, Apple. Even with a 13% growth rate, I would consider a 17 multiple a little high. But the current multiple of 33.54 simply doesn't make any sense. Now, technically, from just a mathematical calculation, if this company were to fall back even to its normal 17 PE, which current growth of 13% really doesn't support that, but say it did, you would see a 31% drop in value over the next 2.5 years or so, annualizing at about 12.7%. If I go to forecasting here and even look at the trend line growth of 13%, if this came down to I'll give it an 18 PE ratio here, you'd make less than 1% a year if it traded at that high PE. That's PE contraction, which would make sense when the company's only growing at 13%. If it only traded at 15 times earnings, which I believe 13% growth would actually indicate the fair value should be, it would actually be a negative rate of return over the next several years. So what I want to do, I want to re-examine this again. Before I leave it, I want to say this clearly again. Look how the market has historically valued this company. And this has been very high valuations at times. Sometimes the PE was relatively low, but there were times when it was a 17 and 18. But this, 14 to 17 PE ratio was a fair value PE ratio, and it made a lot of sense. But the point is, there's real evidence there that that's how the market valued this. Now, you're going to talk to me about all the new stuff that's happening and blah, 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 but this is a $2 trillion company. It's expected to grow at 13% a year, which is significantly less than 17, and yet you're putting this 33 multiple on it, this valuation that's higher than it's historically been by almost twice. All right, I'm just telling you, use your common sense. So what am I saying? So let's say you bought Apple when it was inexpensive here. We'll say December of 2018. And as of yesterday's close, you'd have more than doubled your money, actually tripled your money. 10,000 would have grown to almost 32,000. My question to you is, what would be wrong with selling half of your Apple here, pocketing your original investment plus maybe a 50 or 60% profit? Or for that matter, why don't you sell, a little more than half of it and take out, some nice profits? And then I'm going to show you some options you might have to reinvest that in the future. But the point is, what would be wrong if you don't want to get out of Apple? You can harvest some. Now, clearly this is real. The market has done this with Apple over the last 2 years, we'll call it. I'm not denying that. That's clear. The evidence is right there, just like I'm showing you evidence of historical normal valuations. This evidence is real, but you've got to look at that graph and say, this has to be somewhat anomalous. This has to be a very high valuation. And high valuations usually lead to bursting bubbles, and bursting bubbles lead to fallout. Now let's look at Microsoft. Let's say you'd have gone back here in 2013 and bought Microsoft at a 12 PE. Which is what historically this company would have traded at. It wasn't uncommon for it to trade at relatively low multiples. Since the Great Recession, there were times when you could buy this stock at even single-digit multiples. But let's say you just bought it at a 12 PE and held it to yesterday's close. You've now made sevenfold on your money. Okay, now, again, I've got evidence here showing that, Microsoft never traded at that high a multiple before. The stock, again, is trading at a PE of over 30 times earnings. Why don't you sell half and take maybe 3 times your original investment? This is based on a $10,000 metaphor, and let it run. This stock clearly has momentum. It's extremely popular now. But I just want you to look at this and say, hey, this stock is expensive. Clearly, by any historical standards, it's expensive. Now, a good way to tell that is just look at the earnings yield here. The earnings yield is 2.91%. What that means is if you bought the stock today, okay, and bought 100% of the company, if you had $1,700,000,000 laying around, and you bought the whole company, your return on investment would only be 2.91% if Microsoft gave you every dime's worth of their profit. Now, in reality, as a shareholder, they've only been paying out about 35% of that profit, so your dividend yield is obviously about a third of that. It's less than 1% per year on the stock. This is a very expensive stock. It's had a tremendous run. It's got momentum. It's extremely popular, but that is not fundamentally sound. And that picture ought to tell you. Let's look at another, very popular stock today, and a younger company from a publicly traded. Let's look at PayPal. PayPal's trading at 66 times earnings. The earnings yield is only 1.5%. The reality, if this stock went back to some reasonable valuation, now when I look at forecasting, the market believes this company is going to grow at 22%. That's significantly faster than what they forecast for Microsoft or even Apple, but yet you've got to pay 66 times earnings and would only be receiving a 1.5% earnings yield. You could have a very significant loss over the next several years if this company reverted to a mean fair value of 22 times earnings. That's still a much higher PE than the market, typically trades at. So, let's go on. Let's look at Square. This is another one that's extremely popular right now. Data processing and outsourced services, very hot stock. The stock was flat here for all these years. It has tremendous earnings growth, but then the earnings growth faltered. 2020 it only grew by 5%, and yet the stock had this incredible run up in value. It's gone up fourfold. 10,000 has grown to 45,000 just since March of 2020. And again, what would be wrong with selling half and taking $22,000 out of the stock? And if you're going to continue to speculate on these massively high valuations, you got a PE ratio here now of 265. You've got forecast growth of 30% a year for the next couple of years. The long-term trendline growth is an astounding almost 46%. But let me ask you, does that warrant a 284 PE ratio, an earnings yield of 3.38%, under 0.4% earnings yield? In other words, if this company paid you 100% of their profit and they don't pay any dividend, your return on your investment, if you bought the whole company, would be between 3 and 0.4% per annum. The risk of this stock going back to a reasonable multiple, even at a PE of 46, which I'm using the PE equals growth of 46 here, would mean you would lose 20% annualized over the next 3 years if this stock, ultimately reverts to the mean. Now the question would be, what could you do with that money? Well, I went ahead and I searched all of the information technology sector. I came up with, I think it was 45 names, and I looked for ones that had reasonable fair values or earnings yields of over 7%. And I came up with a list of about 15 stocks. So technology, the whole sector is pretty expensive, but there are some perfectly good companies out there that are trading at reasonable valuations. Here's Arrow Electronics. PE is 12, earnings yield is 7.9%. Forecasted growth, long-term 3 to 5 year growth is 15%. That's faster than either Microsoft or Apple, for example, and you can buy this stock at a PE of only 12 with a 7.7% earnings yield. Why not, sell out of some of these, harvest some of the excessive profits you've made on these high popular tech stocks right now and put it into something like Arrow. Here's Jabil. Jabil is a St. Petersburg, Florida company right in my backyard. It's going to have 59% expected earnings growth this year. It's expected to have an average of about 13.8% over the next 2 or 3 years. And the 3 to 5 year trend line growth is 19%. That's phenomenal growth. Now I've only got a $6.7 billion market cap, and I've got a chance to make some significant rates of return on this stock if it trades at its growth rate PE of 19. Even if it traded at a 15 PE, I could still stand to make, 20% plus returns over the next 4 or 5 years. Now, the market has been valuing this stock at only about an 11 PE. Okay, so let's take an 11 PE and let's look at it down here at an 11 PE, and I'd still make 15% annually if the stock only traded at an 11 PE. In other words, I'm looking at risk reward here. This makes sense to me that you might want to take a look at a company like that and consider it for replacement. I talked about this one in my last article. Here's HP. It used to be the old Hewlett Packard. They spun off into HPE and HPQ. Forecasted growth here is 14%. That's as fast as Apple. We have a $35 billion market cap roughly. At a 15 PE, which would be very reasonable for this company, we could make 34 or 35% a year. If it only traded at a 10-ish PE, which is, what it's been historically trading at, you still would make 8 or 9%. In other words, you're taking a lot less risk here for a company that's growing at 14 or 15%. And I want to stop and take a breath and make a point here. Ultimately, all businesses, all investments get their value from the amount of cash they throw off for the stakeholder. This is growth. This is real growth that we're looking at here that you could earn on your money if you invested in one of these inexpensive stocks. Now, here's Alliance Data Systems. Look how the price tracked earnings. We've had this big collapse in earnings here. And by the way, none of these stocks I'm looking at, I don't really know enough about them to say you ought to buy them. I want to make something very clear. I think they're very interesting alternatives to this high tech, because here's a company where 18 analysts following this stock expect growth of over 19% over the next couple of years on average, and they expect a 3 to 5 year trend line growth of over 18%. Now, this is partially a recovery situation. You can see the stock is turning itself around, okay? But the point is, I think this is worth looking into, and there is technology out there that you can invest in, notwithstanding a lot of other industries like healthcare has some very good values in it. Insurance and financial have some good value. The point is, you've made you've made an incredible amount of profit on these tech stocks. If you invested in them a few years ago, it just makes sense to me. Just common sense would say, hey, I don't mind gambling. I don't mind speculating a bit. I don't mind taking on a little extra risk, because obviously these stocks are popular and, their performance has been, just exemplary here in the last year or two. But this is clearly bubble territory. I just hope you all can see that and not get all caught up. And yeah, but it's got this, it's got the cloud, it's doing all these great things. These are some really exciting tech stocks, no question about it. But the market has, for the most of the time, valued them at much more sane valuations than we're seeing on these stocks now. So, I would just be careful owning these stocks at these levels. They don't make economic sense. The fundamentals aren't supporting it. A company like Apple, how big can Apple get? It's already a $2 trillion company. So all I'm saying is, I don't know if these stocks are going to collapse. I don't know if they're going to stay strong for another year or two. I have no way of predicting what the market might do in the near term. But I can tell you this, I think it makes common sense that if Apple's capable of growing at 13% a year over the next 5 years, that's an awesome achievement for a company of this size. And if it's more, consistently going to grow at about 12.8 or 13% for the next couple of years, these are impressive achievements, but are they worth the multiples and the valuations that the market is currently applying, considering that when it had even much faster growth, the market never applied multiples that high? Long term, Apple was growing at 17, 18% a year, and the market still rarely valued at above 17 times earnings, not 33 times earnings. Anyway, I hope this resonates with you a little bit. You know, I love Apple. Apple's my favorite stock on the planet. I also like Microsoft. Awesome company. I owned both of them, made a lot of money, and I've sold them. I don't regret it. I left money on the table with both of them, but I did pocket a lot of money, and I've reinvested that money in other investments that are also serving me well. What I've really done is I've de-risked my portfolios. And that's what I'm talking about here. It might be time to de-risk a little bit because we're starting to see, signs that interest rates might be rising. We're starting to see some breaks in the bubble here. There's some stress in these bubble stocks. So, be prudent. Take some money. If you don't want to take it all out, harvest your profit, lock in your profit, play on the house money. Anyway, I hope you enjoyed this video as much as I enjoyed doing it. If you liked it, give me a like. Obviously share it with friends if you think it would help someone to see this video. Ring the bell and do all those other good things because I really appreciate all of you. And I hope the audio is better here. I'm working on tweaking my mic and getting a little closer to it so that you guys can hear me better. Anyway, this has been Chuck Carnevale saying thanks for watching. I appreciate y'all.